everyone, and welcome to the premium video newsletter for August 6th, 2013. We're finally seeing some movement in the market, so let's start off with the fundamentals. Released earlier today was the trade deficit numbers, showing that U.S. trade deficit narrowed sharply in June to its lowest level in more than 3.5 years, as imports reversed the prior month's spike, suggesting an upwards revision to second quarter growth in the economy. The Commerce Department said on Tuesday that trade gap fell 22.4% to $34.2 billion. That's the smallest since October of 2009. Economists had expected the trade deficit to narrow only to $43.5 billion in June, so the news was fairly bullish for the economy. The smaller trade deficit lifts growth because it means consumers and businesses are spending less on foreign goods than companies are taking in from overseas sales. Another bullish report was released by a private real estate data provider that showed that home prices were up nearly 12% in June from 1 year ago. On a monthly basis, that's 1.9% in June over May, and 16 straight months of month-over-month increases. Neither of these two bullish reports were able to sustain higher prices in the broad market. Some media reports quoted members of the Federal Reserve saying that the central bank may be close to reducing the bond buying program. The program has successfully kept bond yields low and stocks high. These statements could be partly to blame for the downside volatility that we're seeing in most market sectors, as well as the energy markets. Yesterday, I was concerned that the rally was not broad, and there were several sectors that were lagging substantially. Even techs, which were very strong the last few days, are erasing the gains today. And what's interesting is on the way up, the volatility was rather low, but on the way down, the volatility is really picking up. Looking at the daily chart of the NASDAQ index, which is largely made up of tech stocks, we saw 3 days of gains erased today. Always remember that momentum to the downside is much stronger and quicker than to the upside. And this is because fear is a much stronger emotion than greed. The broad market is no exception. The downside pressure is strong and could get even stronger because volume is light. So it doesn't take very much selling to cause a lot of volatility. The support level I'm looking at is 1680, and if we break that, we will more likely than not move down to the 1660 level. I will need to look at how quickly we break these levels and which subsector is leading and lagging. But overall, I want to see how we break the 1680 level and if we bounce off that level as well. Keep in mind that Thursday we have important employment data coming out, so this will also play a large role in what happens in the next few days. As you know, I always look at the transports because they tend to lead the broad market, and it looks like we are already in our third down day, and volatility seems to be only expanding to the downside as well. Keep in mind that this is an ETF and it's tradable. The next target is the 114 level, and if we break that, we will be moving down quickly because there's very little support till we hit the 112 level. Let's not put the carriage before the horse and see if this momentum will continue into the second part of the week first. Another market that we haven't discussed in a few days is the crude oil market. This market is also extremely sensitive to the U.S. economy and is selling off after testing the recent high a few days ago. If you recall, I thought we would test the recent high and back off unless there were some unforeseeable news coming out. We didn't see anything from the Middle East, and I believe what we're seeing right now is a combination of technical trading and fear that the Feds will discontinue the stimuli program sooner than later. I think we will go slightly below the 103 level, and once we are there, I will take another look. There's really nothing stimulating the crude market right now, so don't expect much to the upside for now. The most notable event in currency markets Tuesday was the decision by the Reserve Bank of Australia to cut its main interest rate to the record low of 2.5%. The quarter point cut was smaller than anticipated and caused the Australian dollar to rally. The long-term trend is down, and we recently broke a reasonable support level a few sessions back. I would look at this as a selling opportunity above anything else right now. The only question is how high and how far away from the trend the market will go. In my opinion, we have a lot of resistance near the 92 to 92.5 level, and I'm being very optimistic to think we will go that far. So you can see I'm not overly bullish on this market, to say the least. If you are short, don't panic at these levels, and if you're looking to go short, you may want to wait just a bit longer before entering the Aussie on the downside. The fundamentals are not strong enough to carry this market too much away from the main trend, which is now down. Another currency that I've been looking at is the yen, which is continuing the momentum to the upside. The current level is just a hair higher than the breakout level, so we should be careful and possibly wait for a confirmation a bit higher before taking this rally too seriously. I trade currencies primarily on technicals, and the longer we can stay and continue to bounce off of the support level, the more buyers this market will draw in. But right now, we really need to see a stay above the current levels for at least a few days for real buying to develop and propel this market to the 104 level. Lastly, the US dollar is at an interesting level right now, and once again, till the US monetary policy tightens, we will not see the higher US dollar prices. The current level, which is near the 81.50 level, is a multi-day support area, and if we go much lower, we will break it and head down to the 80.5 level, which is my target and has been for over a month now. So we shall see what happens later in the week. But we are at very important price levels at this point. If you trade ETFs, send me a quick note and I will provide you several currency ETFs for you to review. Looking at the setups, we have a short tail gap in the direction of the trend. The ticker is SAP, and you should sell 10 cents below today's low on a sell stop. If you're filled, place a protective buy stop 15 cents above today's high price. Give the trade about 2 hours to fill and then cancel it if there's no fill. The second setup is a tail gap to the upside. The ticker symbol is LINTA, and you should place a buy stop 10 cents above today's high price and give this position about 2 hours to fill as well. If there's no fill, cancel the order. If you are filled within the first 2 hours, place a protective sell stop 10 cents below today's low. That's it for today's tutorial, and I will touch base with you tomorrow morning and earlier if I see something unexpected. Have a great night, everyone.